Hi, I'm Stefano Carnevale, a senior investment consultant at Quantum and form part of our Fiduciary Manager research team. In this video, I'll be discussing recent trends that we've been seeing in the FM market. Before we begin, it's probably worth reminding ourselves what fiduciary management is. FM has a number of names. You may have heard it as a delegated investment solution or the appointment of an outsourced chief investment officer, an OCIO. The principle of these approaches, at the core, are all the same. They are governance solutions which allow trustees to delegate investment decision-making to a third-party manager. The level of delegation can vary across trustee board and is often dependent on a number of factors, one of which is usually the level of investment knowledge and expertise that a trustee board has. It's important to understand that whilst trustees can delegate investment decisions to an FM, they cannot delegate responsibility of the strategic investment policy. This policy remains the responsibility of the trustees. What is delegated is the implementation of this policy. Trustees will also retain responsibility for the oversight of the manager on an ongoing basis. The approach to how an FM implements a policy will differ. For example, some may use in-house funds, whilst others may use a range of different third parties and choose the perceived best in class across different asset classes. So what are we seeing in the FM market? There are many reasons why an FM solution may be the most appropriate governance solution for trustee boards. Often, the main benefit of an FM solution, which is cited, is the ability for the manager to implement the tactical allocation views that they have quickly. These views should then provide additional value add to clients' investment portfolios. Tactical shifts often occur within the return-seeking portfolio of an investment strategy. A shift out of equities into credit, for example, or a more specific shift from one sector or country to another. However, we've noticed that the focus of many FMs has instead shifted to the management of the mandate's liability hedge, where arguably less tactical asset allocations can be made, and the value is actually at a strategic level. Our research has suggested that generally, as scheme funding positions have improved, tactical asset allocation shift have had less of an impact on the overall investment objective. This is to be expected as there has been an obvious shift in the target returns from the FM market. Over a one-year period, we have noticed a 5% decrease in the number of mandates targeting returns in excess of approximately 2% above liabilities, and a similar increase in the number of mandates targeting either no or very small outperformance over liabilities. Supporting this is the fact that we have seen hedge ratios from mandates increase. The number of mandates that target a hedge ratio over 90% of their liabilities has increased by approximately 7% over the same one-year period. This implies that FMs have been taking advantage of improved funding levels and focusing their attention on increasing the hedge ratios rather than generating outperformance from within the return-seeking portfolios. Trustees often pay a premium for these services of an FM relative to, say, a more traditional advisory approach. We have noticed that fees have remained broadly consistent across many different asset tiers, even as the de-risking exercises have occurred. So what should trustees be thinking about when it comes to their FM arrangement? Firstly, take a step back and consider whether an FM governance solution remains appropriate, particularly if the scheme has a very clear goal of transacting with an insurer in the short term. Lower target returns call into question the need for more complex investment strategies. Secondly, consider the fee being paid. Consider the fee relative to the investment strategy and the services that you are receiving. Is that still appropriate? This again is heavily linked to the target return and level of complexity within the strategy. Thirdly, is a suitable level of oversight being provided on the investment decisions being made by the FM? And finally, are trustees partnering with the right manager to achieve their goals, particularly if the scheme finds itself in an improved funding position?